Welcome, I'm Pat Mitchell, and tonight we are going to be discussing risk management, something that is grossly overlooked in the world of day trading. So to get right into it, what is risk management? Well, it means exactly that. You, yourself, because you need to take responsibility for your trading, are managing your risk. See, a lot of people, what they're doing is they are essentially taking trades with no risk management, no risk in place. Now, that's a beauty thing about what I do. I have a two-part strategy. I have my execution strategy, and then I also have a risk management strategy. And that risk management strategy is even more important than the execution strategy. That's what will make or break a day trader. And the fucked up thing is, 99% of all retail traders out there focus on executing before they even have a stop in place. So how do we fix that? Well, you need to do a little bit of history. History is our greatest ally. So I'm going to fill you in a little bit on my risk management strategy. I call it standard risk. And at first glances, it looks like an arbitrary 1-point stop. Now remember, I trade the vehicle of options, but I am trading the stock, okay? So I'm placing my stop essentially on the stock chart. That's number one. Now, number two, I'm trading SPY, Qs, AMD, Apple, MU, Tesla. Proper stocks is what I'm trading. I want heavily institutionally traded stocks. That's what I love because they are flawless. They are going to respond to technicals extremely well. So that's kind of number two. Trade proper stocks. Trade something that you can have some sort of chart history on. Now, again, like I said, I have roughly, and it's not on all of them, it's about a 1-point stop. It depends on the stock. And we'll use SPY for an example. I use a 1-point stop. That is standard risk. Now, in times of volatility, if we are in a very volatile market, at lows or at highs on the chart, on the daily chart, I will go 1.5 times, 1.25 to 1.5 times standard risk. That would bring it up to 1.25 points per share or 1.5 points per share, dependent. Again, it looks like at first glances, it is just an arbitrary, I'm going to give SPY 1 point. No. So basically developing standard risk was a lot of work. There's years that went into this risk strategy. It is a matter of watching the market, how it responds in certain situations with certain catalysts, certain times of year, what it does when the daily chart is consolidating, what it does when it's at lows, what it does when it's at highs. It takes a long time to produce a strategy. Again, and I know I've done a lot of videos on this, a lot of people like to think that strategy is I'll take a double bottom or a higher low. No, those are setups. Setups versus strategy is night and day, folks. Okay, so if you're trading setup, you don't have a strategy. That's not strategy at all. Okay, so now when it comes to risk and understanding the history of these charts, that's what's important. What does it do in certain situations? And I'm going to give you a little clue. Okay, and I don't want to come out and just say exactly what it is. I want you to hunt for it because those that are taught how to fish will be able to feed themselves for the rest of their lives. There's a reason why I have the coaching style that I do. Now, I can tell you and I can hold your hand, but you're not going to retain it and you won't implement it. So I'm going to give you a little tidbit. I want you to look at the bodies and the wicks of those candles and use your crosshairs and go under those 4 or 5 situations that I just listed and go through it and then go back on the chart and you're going to have a major light bulb moment. You're going to see, oh shit, this is why his risk strategy works as well as it does. This is why he has very rarely a red day. There are levels to this, ladies and gentlemen. There is. And I want you to understand that. Another thing that we can talk about risk where a lot of people go wrong is they will under risk. Now remember, my risk strategy, I didn't develop my risk strategy. The market did. The market told me what to do. And I don't mean in some weird abstract way. No, that's the market told me exactly what to do and how to risk. So if you are telling the market how you want to risk, that ain't gonna work. Where a lot of people are failing is they're under risking, like I said. So if you notice, okay, I want you to notice this next time. On a chart, let's say SPY, Apple Qs, AMD, whatever, doesn't matter what stock. Let's say it puts in a double bottom or a triple bottom. It has a base down there, okay? What happens as soon as it breaks that support? It immediately, you're gonna see a big red candle, right? So if you're working a trade long and it breaks that support, who do you think knows that? Who do you think knows that the majority of retail traders will stop out the second that breaks by a penny? Institutions. Well, how do institutions, especially when the daily chart is at lows or on a dip, how do they get in? Well, they can't just magically buy shares that don't exist, right? Remember, they are trading with massive size. They are buying hundreds of thousands, if not millions of shares. Remember that. You can't just buy 1 million shares, 2 million shares of SPY. That has to come from somewhere. For every buyer, there's a seller, and every seller, there's a buyer. So they take a look at that. I'm sure you've all heard, well, market makers will look for where your stops are placed and stop you out. Kind of. That's kind of what it is. But how many times have you noticed that support break, it washes out and immediately comes back up? The times that you notice that are going to be when the daily chart of that stock is at lows, not up at highs. That's a short, or a short squeeze if it wants to go higher. But I'm talking a traditional dip. That's when it's going to happen, folks. And it's about recognizing that the daily chart has 4 or 5 different sections to it. But I want you to focus just on 3 for now. Highs, lows, consolidation. And I want you to start developing your risk strategy with that information, as well as what I told you about the bodies of the candles and the wicks. There's a pattern there, guys. If you look, and you look properly, that chart, that market will tell you exactly how to develop your risk strategy. Now, if you want to, which I would recommend, even professional athletes and high-level CEOs have coaches and mentors, come to a guy that can give you this, okay? Now, I'm not trying to sell you on my service. I want to train you guys on X and Twitter and on YouTube. This is why I'm doing these videos, right? Don't under-risk. How many times have you seen that where it washes out because it broke by a penny or two? Remember, these are hundreds of dollars per share stocks. If you can't give it more than a point, or more than like 20 cents in this case, you're doing it wrong. How many times have you been stopped out just for the stock to come right back up or go in the direction that you want? It's happened a lot, hasn't it? If you're honest, it happens a lot. Well, that no longer happens. So we worked it out. The levels will work 85% of the time. That 15%, it'll come down to standard risk. And it is 15% of that 15%, so we're talking nil, that it'll actually break that. The only time that it's going to come lower than that standard risk, the clues that I gave you to mark it out for yourself, that is only going to happen so rarely that it'll break that. It doesn't happen. There has to be catalyst. And remember, if there's major catalyst, I'm a technician, I'm a technical trader. I don't fuck around with catalyst. You know how a lot of people out there, they'll say, oh, catalyst is your friend? No, it's not. That chart will become heavily irrational. Now, some people will debate that, but this is where you need to zip that mouth up, turn on those ears, and listen. Listen to a guy that's been doing this for a very long time, consistently and successfully. Stay away from catalyst. Stay away from that. You don't want that. If you are a technical trader, you want pure technicals. Pure technicals are super reliable. One of the major times that support or resistance, those technicals will fail, is due to catalyst. Now, yes, news can drop at any time. I understand that. That's fine. But if you're paying attention, you learn from somebody that has been around the block a few times, you'll know that it's coming. Okay, now that might sound crazy, but you will. You will know that it is coming. So talking about staying away from catalyst and being a pure technical trader, it's one of the things that needs to go into your risk strategy. What type of trader are you? You don't know how many times I have seen a technical trader focus on news, focus on fundamentals. What are you doing? What the fuck are you doing? Using scanners and bullshit? What the fuck are you doing? Are you a solely news-based trader? Are you a strictly fundamental-based trader? Are you strictly a technical-based trader? Know what type of trader you are, or you will not make it. And if you're one of those people that is saying, no, that's bullshit, I can use all of that. No, you can't, not consistently. It's too muddy. That would be like talking on the phone and on the other end, there's 5 different people yapping. How much of that conversation are you actually going to understand if they're all speaking about a different conversation? It's not going to happen, is it? It's the same thing. You need to focus and narrow down. That needs to go into your risk strategy. The important thing about risk is not under-risking. And some will say, well, I can't take that because I need to risk 1.5 points or 2 points on that. Size down, motherfucker. Don't always just throw a certain amount, a designated amount of contracts or shares at a position. Why are you doing that? You need to size according to your risk. Now, let's say, and I'll give you an example of that. Let's say your support level is at $100 and you're risking down to $99. That is your stop, okay? Example B is that 100 support level, but then that risk, because it's a volatile market or you have a technical support level just below it, is $1.75 a share. Are you going to take 50 shares or 50 contracts on both of those? Or do you take 50 on the one that you're comfortable with on example A, and example B, you're going to size down. And because it is almost 2 times, instead of using 50 contracts, I would use 25 contracts. So because it's $1.75, I would probably be in the neighborhood of 30, 35 contracts instead of the 50. Do you understand? You size according to your risk. Don't just throw a bunch of size at shit on every single fucking trade you take. That's nonsense. That's not having a plan. That's really not knowing what you're doing. So stop undersizing. Stop not sizing according to risk. Have an actual plan and understand what type of fucking trader you are. Adios.